Today, we're going to talk about the basics of leverage in real estate investing, focusing on how to effectively use debt. The key idea here is that borrowed capital allows you to control larger properties without needing to put down as much of your own cash up front. This can be a powerful way to grow your investment portfolio. However, it's crucial to stay disciplined with the deal to make this approach work. Remember, debt should be seen as a tool to help you achieve your goals, not as a standalone strategy. Using leverage wisely can amplify your returns, but misuse can lead to risk, so careful management is essential. Leverage is a powerful tool because it allows you to control a larger real estate asset with a smaller amount of your own cash. By using debt, you increase your buying capacity and can potentially boost your returns without having to pay the full price up front. There are three key points to keep in mind. First, you can acquire a bigger property with less cash down, which means greater opportunity for growth. Second, if the income generated from the property exceeds the cost of the debt, your equity returns actually increase, enhancing your overall profitability. And third, the cash you save by using leverage can be redirected toward property repairs, reserves, or even your next investment, giving you more flexibility and control. In essence, leverage lets you get more control for every dollar you invest. Multiply your potential impact in the real estate market. Here, we're comparing two scenarios to understand the impact of leverage on an investor's return. In the first case, the investor buys a property entirely with cash, $500,000 from their own money. After 1 year, the property generates a profit of $50,000. That means the return on equity is 10%, simply the profit divided by the full cash invested. Now, in the second scenario, the investor uses leverage, putting down only $100,000 of their own cash and borrowing $400,000 as a loan. After paying debt costs, the profit reduces to $20,000. However, because the investor used less cash up front, this $20,000 profit represents a 20% return on equity, which is double the first case. The key takeaway here is that by using debt to finance part of the purchase, the investor can amplify their return on equity. But this advantage only holds if the property's income sufficiently covers the loan payments. Otherwise, the risk increases. So, leveraging allows less cash invested up front to generate a higher percentage return, assuming the debt costs are manageable and income supports it. On this slide, we're looking at three main types of real estate debt that are commonly used in service. First, we have a conventional mortgage, which is a standard option. It offers the lowest interest rates for stabilized properties, making it cost-effective over the long term. These loans come with longer terms and predictable payments, providing stability for borrowers. However, they do require stricter qualifications, including higher income, credit scores, and down payment standards. Next is a hard money loan, designed for speed and flexibility. This type of financing is short-term and great when you need quick access to cash. Keep in mind, though, that it comes with higher interest rates and lender fees. Hard money loans are often used for flipping properties, bridge deals, or financing distressed assets where traditional loans aren't feasible. Finally, there's the home equity line of credit, or HELOC. This allows you to borrow against the equity in your own residence and offers a reusable line of credit that can be handy for down payments or renovation projects. The key point here is that HELOCs have variable interest rates, so while they offer flexibility, they can also increase your carrying costs if rates go up. Each debt type serves different purposes and comes with its own advantages and considerations, depending on your project's needs and financial situation. Here, we're focusing on the loan-to-value ratio, or LTV, which is a crucial concept in real estate and lending. Essentially, LTV measures the size of the loan compared to property's value. When the LTV is higher, it means you're borrowing more relative to property price, so you're putting less cash down up front. However, this comes with trade-offs. Lenders usually impose stricter conditions, and there's less room for mistakes financially. For example, if a property is valued at $400,000 and you have a loan of $300,000, the LTV is 75%. If the loan ramps up to $320,000 or $360,000 against the same property value, the LTV rises to 80% and 90%, respectively. The key takeaway is that the property value essentially sets the ceiling for your leverage, defining how much you can borrow safely. This formula, loan divided by value, helps you calculate that ratio easily. Understanding this balance is critical to managing risk and planning your investment strategy effectively. Let's talk about pricing and what really drives the cost in a loan. The key factor here is the interest rate. Even a small change in the interest rate can have a bigger impact on your monthly cash flow than any other loan cost, making it the primary cost driver. Interest rates are influenced by several factors, such as your credit score, the type of property, and current market conditions. On the other hand, we have typical costs like origination fees, points, and closing costs. These are upfront expenses that you pay at closing, so they reduce the cash you need on day one, but don't affect your monthly payments. Understanding the difference between these ongoing and upfront costs is crucial in evaluating the overall affordability of a loan. Let's take a closer look at cash flow, which is really the bottom line in any rental property investment. We start with rental income. This is the gross rent collected from tenants. From that, we subtract debt service, meaning the mortgage or loan payments you have to make each month. Next, we take away operating expenses, which include taxes, insurance, repairs, and other costs necessary to keep the property running smoothly. What remains after all these deductions is your actual cash flow, the money left over each month that you get to keep. For example, imagine a single-family rental with a gross rent of $2,400 per month. After paying a mortgage of $1,450 and covering $450 in taxes, insurance, and repairs, you're left with a monthly cash flow of $500. It's important to pay attention to this number. If your cash flow is too thin, it indicates that your leverage or the amount of debt you're carrying might be too high. In other words, you might be overextending yourself financially, which can be risky. Positive and healthy cash flow is key to a successful and sustainable rental investment. On this slide, we're focusing on three key types of risks that can potentially cause delays or issues in project. First, we have market risk. This is about the possibility that if rents decline or property values drop, the equity you have in the asset can quickly disappear, which is a serious concern for any investment. Next, there's cash flow risk. This occurs when the income generated by the property isn't enough to cover the mortgage payments, forcing you to cover the shortfall or, in the worst case, risk losing the asset altogether. Finally, we have leverage risk, which involves taking on too much debt. Over-leveraging leaves little room for error. Any vacancies, unexpected expenses, or interest rate increases can amplify losses, making the financial situation much more precarious. Understanding these risks is crucial for effective risk management and avoiding potential delays. When building your first deal, it's important to follow a disciplined sequence to keep everything on track and avoid issues. The process moves step by step, and skipping any step can cause delays or problems, represented here by the board going red. First, you start with researching the property thoroughly. This lays a foundation for everything that follows. Next, securing financing is crucial to ensure you have the necessary funds in place. After that, you move on to closing the deal, which is a transaction moment where all the pieces come together. Finally, managing property properly once the deal is closed ensures long-term success. Remember, the sequence matters. Each step builds on the previous one. So staying on time and in order makes your first deal a smooth and successful experience. When you're searching for the right lender, it's important to remember that you shouldn't just shop for the lowest interest rate. Instead, focus on how well the lender executes the deal. First, consider the interest rate. While a lower rate does improve your cash flow right away, don't overlook closing fees and prepayment terms. These can quickly negate any savings you might expect. Next, look at flexibility and structure. The loan terms should align with your specific deal. Options like amortization schedules, reserve requirements, and exit timing can make a big difference. Avoid lenders with rigid terms that could potentially hurt a good property. Approval speed is another critical factor, especially in real estate where timing is everything. Fast lenders are more likely to help you secure competitive deals. Always ask about the actual time underwriting and funding take, because delays can cost you a contract. Finally, don't underestimate the importance of customer service. You want a true partner who's responsive and proactive, not just a hotline to call. Good lenders help solve problems before they escalate, both at closing and throughout the life of the loan. So the best lender isn't just about getting the best rate, but also about finding the right fit, certainty in timing, and ongoing support. Keep these criteria in mind, and you'll be well positioned to choose a lender who really meets your needs. Here, we're looking at some common mistakes to avoid when managing investments or loans. First, over-leveraging is a big risk. Always keep reserves so that a single vacancy won't jeopardize the entire deal. Chasing only the lowest rates can be tempting, but it's crucial to underwrite the total loan cost, including term, fees, and prepayment risk to get the full picture. Ignoring cash flow is another major pitfall. Rent needs to cover not just a debt service, but also leave room for repairs and unexpected expenses. Another key point is having an exit plan. You need to know ahead of time when you're going to refinance, sell, or pay down principal to avoid surprises. Finally, discipline is essential. It prevents delays and ensures you stay prepared. The phrase punklich reminds us that being on time means being ready. Keeping these points in check can help steer your investment away from trouble. As we wrap up, let's focus on your path forward with debt. Using it strategically, not just hoping for the best. The right loan is one that expands your opportunities, safeguards your cash flow, and ensures that if things go wrong, you can still manage. Start by setting your buy box and maximum payment before you begin shopping. This keeps your decisions disciplined. Next, compare lenders based on the total cost, not just the interest rate, because fees and terms can make a big difference. Finally, only borrow amounts that keep your investment viable even under stress scenarios. Every deviation from your plan needs to be accounted for to stay on course. This approach will help you move forward confidently and on time.